Good afternoon. Laurie Heinel is the Global Chief Investment Officer at State Street Global Advisors, with responsibility for their range of investments, all the way from index funds to alternative investments and everything in between, and provides direction for a team of over 600 asset managers around the globe. She's with us today to discuss some of the hot topics in the asset management industry. Laurie, thanks so much for joining us today.
My pleasure.
Laurie, one of the hottest topics at our conferences in recent years has been the rapid growth of ESG investing. We talk a lot about the regulation, the reporting, and the structuring, but we rarely ask the question of why the investors are increasingly focused on this.
I think there are several things that are driving the interest in ESG, and some of those are the legacy reasons that investors may have been interested in ESG. Notably, oftentimes they still want to align their value system with their investment portfolio. So we continue to see interest in exclusionary activity where a particular fund might want to exclude certain kinds of assets. You know, the traditional ones are things like tobacco and firearms. But also, I think climate has become a really important thematic for investors. And so thinking about how to invest in a way that helps address some of our climate issues is something that we've seen a lot of interest in. I'd say that the more compelling paths that we've seen over the last several years, though, are more this idea of integration or understanding that ESG issues have very far-reaching implications for companies, and trying to identify what those implications might be and how to integrate some of those considerations into the portfolio is definitely an emerging trend that we've seen over the last couple of years.
I think that some of the things that I've heard put forward are compatible with the traditional fund manager's role. It's about alignment of risks and rewards and recognition of climate risks in your portfolio, but some of them are more altruistic with an external benefit. How do you think about your duty to your investors, to your fiduciary duty to maximize the risk return, bearing in mind that some of the benefits are outside the portfolio?
So in situations where we're acting as a fiduciary and it's our point of view versus a client-directed point of view, we anchor first and foremost on that responsibility to deliver the best investment outcome. So that's the best risk-adjusted return. That's basically replicating a benchmark, or it's doing something else that is really prioritizing that investment outcome over any other consideration. So that's definitely the posture that we take. Having said that, what we're finding over and over again is that some of these ESG related issues do provide informational value that can be integrated into the decision-making process and actually give you a better risk reward result. So the primary thing that we focus on is, are there ESG elements, whether they be related to climate, as I mentioned before, they could be related to diversity. You may know that we've integrated a lot of diversity thinking into our portfolios. They could be other things related to workers' rights, governance related issues. All of those ultimately can be traced to a long-term company sustainability and a long-term company risk and reward, which we believe drives equity prices. So it really is this idea of understanding deeply how the ESG considerations might manifest in the company's own operations, and then being able to invest in a proactive way.
There's a lot of work on the correlation between ESG scores and performance on various metrics, whether it's equity or fixed income.
No, that's absolutely right. And just to maybe draft off of that, in our quant businesses, which of course, integrate a lot of, quantitative factors and invest in a very large universe of securities, they've actually identified an ESG related factor that they believe is a different measure of quality of a company versus traditional balance sheet metrics like leverage. And one of the things that they believe is that companies who pay attention to their ESG footprint and profile and proactively manage that actually are better managed companies, and that accrues to a longer term shareholder result.
Sounds like important research to be done. When we prepare for this conference every year, we speak to some of the sponsors, some of the stakeholders, and we ask them what we should be talking about. I think the biggest change that I've noticed in those conversations this year was inflation. It kept coming up. Now, the Fed seems to think that it's transitory, but all of the investors and all of the stakeholders kept saying, we want to talk about inflation. What are you hearing about inflation risk? And do you think that it's already started to influence asset allocations?
Well, certainly that's one of the hottest topics that we're debating amongst ourselves. And I would say that even within our own organization, there are different camps of people who see the inflation trajectory differently. So it's a very, very active debate. On balance, I would say we think that the Fed and other policymakers are being just a little bit sanguine. Certainly their posture is that they have plenty of tools to battle inflation. They don't feel as though they're behind the curve. They think that these effects are transitory. We actually think that there are building inflationary pressures that are not just transitory inflationary pressures, and they're being compounded by some of the increased fiscal stimulus that you're seeing, not just in the US, but you're starting to see in Europe as well. So we're more of the camp that while inflation may prove to be transitory and it may not be something that gets away from central bankers, we think that the risks have increased quite a lot, that they're going to get a bit behind the curve here. And so we're starting to pencil in some earlier trajectory for interest rate increases than what the central bankers have posited themselves.
And that's starting to influence asset allocation decisions already?
Well, at the moment, it has been in a sort of interesting way. Our primary focus on asset allocation right now remains this recovery trade, right? This idea that economies will continue to grow. They're coming out of lockdowns. The vaccinations are getting rolled out en masse, et cetera. So the primary way we're expressing that in the portfolios right now is equity overweight. And as you can appreciate, a little bit of inflation is actually good for equity prices. So if you get that sweet spot between sort of very, very low sort of single digits up to about middle single digits, so 4.5%, that tends to be a reasonably good place for stock investing because you have pricing power on the parts of companies. So it's less about, are we worried that there's going to be massive inflation and you need inflation hedges at this juncture at least. It's more about playing this reflation, this reopening trade, and that leads us much more to equities, which by the way will do well in a little bit of an inflationary environment.
Right. And then thinking if you are even more of a bullish on inflation, you think it's going to go even higher, then it starts to go away from equities and other asset classes?
It does. And again, there are a variety of ways to play that. Certainly commodities, and we've started to add a little bit of commodities exposure to our portfolios over the last couple of months, and that's been building a little bit. Also paring back fixed income. And again, we've been quite underweight government bonds, for example, for many years now. So the primary place that we're paring back there is credit and high yield, which is less about inflation and more about just fully valued parts of the market and moving that into commodities and into equities, for example. And then also the question of how do you play equities? So within equities, thinking about maybe emerging markets as a place where there could be more opportunity, or starting to look at parts of the market like Europe, for example, that are relatively more attractively valued. So a lot more nuance than just a kind of gross, let's go into commodities and or real assets and ride the wave.
Mm. With the changes that we're seeing, can I just ask about the influence of that on the asset management industry itself? When you've had a bull run in both fixed income and equities, there's been a relatively low beta between the different asset classes, and we've seen a huge growth in passive investing and ETFs. If we are seeing a change in the interest rate cycle, if we are seeing some fundamental changes like inflation, is that going to start to influence the very structure of the asset management industry? Are there going to be disruptors coming in and changing the existing landscape?
Well, this is a very loaded question. I'll start with the simple answer, which is we do believe that a reversal of all the trends that we've seen over the last many years should be good for active managers. So if you think about the kind of the macro, the beta trade, so to speak, as you said, it's been a great place to invest, whether you're fixed income or equities, especially if you're in an access vehicle like an ETF or an index fund, because there's been lots of money to be made. But we actually think that we're entering an environment where there should be more differentiation across securities, across companies that are actually navigating this change better than others. So we would imagine that this will bode well for active management. The other thing I think that's really interesting is this whole idea of disruptive force. And I think it's less about what's going on with the rate environment or with, the beta, if you will, and much more about these emerging sort of fintech or these emerging decentralized finance or these other emerging platforms. So you look at these, a number of things that we've seen just in the last couple of months, where you've got the meme stocks, for example, where all of a sudden individual investors are able to move a particular security in massive amounts because they kind of conglomerate around a trade, if you will. That's not new in a sense, but the magnitude of it is definitely more than what we would have seen in the old days, where you maybe had a newsletter writer who had a following and they talk about a stock and you'd see a little bit of a pop in it. But this is much, much more profound. You also had this emergence of whole new asset classes. So you think about the non-fungible tokens and the idea that tokenization can, in a sense, move collectibles or other kinds of idiosyncratic types of assets into a more mainstream sort of a posture. We've seen disruption in terms of the whole capital markets operation. So you think about SPACs, for example, where essentially these special purpose access companies enable a route to an IPO that's, again, very democratic compared to the traditional way. So I'd say those are the kinds of more disruptive forces. It's a little hard to see how this all plays through, but it's something that we're certainly looking at from an investment thematic standpoint, from a disruption and liquidity standpoint, and from a market volatility standpoint.
I'm sorry, yes, it was a totally loaded question. It just seems that it must be very difficult in your position with a very large model, very large business behind you to react to such bizarre things as GameStore and these kind of scenarios.
Yeah, well, I guess I tend to go back to fundamentals. I was trained kind of classically, as I'm sure many of your listeners and readers and whatnot are. So I go back to first principles. What are the primary drivers of risk and return, and how do you think about asset classes, and how does that manifest in portfolios? And then ultimately, there's a whole nother daisy chain for, where can you find incremental value through security selection or through tactical or other things. I think what's interesting about these other developments is they have profound opportunity to stabilize different parts of that daisy chain. But if you think it through in a kind of classical way, you still have a path forward. So if you think about, some of these fintech types of things, I am a believer that the thematic is an important thing to consider. So how is the thematic disrupting various industries, whether it be retail or whether it be banking or whether it be other things, and how do you factor that into your security selection process? But these are also early days in terms of some of these collectibles becoming asset classes. So we've been much more cautious on investing in some of these, whether it's cryptocurrencies or non-fungible tokens or other things. That's not a place where we're looking to invest from an institutional standpoint at this stage.
Yeah. Well, that was actually going to be my last question. And non-fungible tokens, perhaps a most extreme version, but there's an awful lot on Bitcoin. And if I consider myself a traditional investor, 60-40 portfolio, but I'm starting to worry a little bit about inflation. My traditional hedge has been gold, but a lot of people are saying Bitcoin. What's my one little side bet to protect myself from inflation?
Yeah, so we would still be in the gold bug camp, or I would be in the gold bug camp for sure. If you look at cryptos and Bitcoin in particular, they're just not stable correlations. So it's really, first of all, we don't have a lot of history to fall back on the way that you do with gold, but the little bit of history that we do have does not suggest that there's consistency in the diversification benefit of Bitcoin. So I would say that that's not the way to hedge against inflation. It may prove to be a good inflation hedge, but it may very well not. And certainly we've seen other forces that suggest that when Bitcoin trading falls below its sort of moving averages, it tends to stay there for a long time, which suggests that the trading activity is overwhelming the diversification benefit.
Right. So with gold as my inflation hedge.
It is indeed for now, or commodities to some degree.
Understood, yeah. Great. Laurie, thank you so much for joining us today. Really appreciate it. And thanks very much.
Thank you.